For anyone that does not know, the global bond market basically rolled over and died today. And there really wasn't a good reason or causation for it. In fact, in Germany, you had better than expected inflation news, and Germany's bonds still died. And yes, if you're confused by bonds dying, that means the price of bonds fell and the yields went higher across the world. And what's interesting about this is nobody on Wall Street has any idea what's going on besides this individual. And yes, I will play the clip in just a moment. But this is important to pay attention to because bond markets usually signal trouble before trouble actually appears. Or bond markets can signal good things before good things happen. That is because the bond market is much larger than the stock market. So typically, the bond market is correct and stocks just follow suit afterwards. Now, what's most interesting about bonds today, especially US Treasuries, is we do have a big catalyst coming tomorrow morning with a speech from Fed Jerome Powell and your JOLTS job openings data. Now, 10-year Treasury yields have recently risen about 26 basis points in just the last couple of days of trading. The 10-year Treasury yield today was up almost 13 basis points. At one point, you were up 14 basis points. That only happens if you get a really hawkish Fed Jerome Powell, if you get an inflation report that is a super surprise hawkish number. Now that usually only happens if you get really bad news. That could be a hawkish Fed Jerome Powell. That could be an inflation number that comes in really bad, or a non-farms payrolls report that comes in at 300,000+ jobs. The signals the Fed does not need to cut rates anytime soon, but something usually causes it. So as you've seen 10-year Treasury yields go parabolic today, something definitely caused it. Well, this individual may have the answer to that.
Jim LeCamp able to join us now from Morgan Stanley. Jim, it's great to see you again. Long time no speak. What's your take on not so much this decision itself, but the extent to which the election is taking up a lot of your headspace in terms of how bullish or bearish you are in the market?
So neither one of these guys are geniuses when it comes to economics, right? I mean, when you look at the current administration, they're spending money like no administration has spent before, and that's saying a lot because they all do. Then you have an administration that could be coming in that wants to raise tariffs, and both want to cure inflation. And it makes me wonder, who taught these guys economics? I mean, the two things you wouldn't want to do if you're going to try to bring inflation down is have runaway government spending and deploy tariffs around the world, which implies that you're going to get the countermeasures, which would be tariffs over here, and that's prices higher. So I don't think the Treasury market particularly likes either outcome. And actually, oddly enough, Wilfred, and it is great to see you, by the way, oddly enough, that's one of the things I think that's helping the stock market is that people don't trust the bond market. They're looking at a Treasury rate of 5%, inflation rate at 3.3%. You have taxes on top of that. We have all these treasuries that we have to issue because our deficits are running so high. And then you have the Japanese bank going bankrupt, selling 63 billion of U.S. treasuries, and a lot of foreign governments and central banks around the world offloading treasuries. It makes the outlook for bonds just a little uncertain, and I think that's one of the things that has helped the stock market, oddly enough.
But I guess that might be a kind of positive asset allocation factor in the short term, but some of the themes you're talking about there in the more medium to long term, and maybe therefore they're not factors for the second half of this year for the stock market, but they're pretty worrying if we're talking about the US Treasury market falling out of bed and yields rising pretty sharply. That's bearish for all asset classes.
It is, and it's a big concern, Wilfred. When you look at the last $1.5 trillion that we spent in government spending, and by the way, government spending is one of the components of GDP. So we have a GDP print that was 1.4% in the first quarter. That includes a lot of government spending. That's not very good. And that $1.5 trillion that we spent gave us $1 trillion in growth. So it had a negative multiplier. And when you move that forward, that's not a good outlook for the economy, and it's not a good outlook for the dollar. It's not a good outlook for stocks in the long run. In the short run, we might be okay. The trends are okay. We haven't broken any trends historically. When you have a good first half, you have an even better second half. First 2 weeks of July historically are pretty strong. So we may be okay in the very short run. But in the long run, I think there's a lot of concerns, and this is no way to run it. It's kind of like running a diabetic economy. We're relying more and more on these sugar injections, and it's not a good path in the long run at all. But in the short run, I still think the market looks okay as long as you stay focused on companies that are growing. Problem is, what's good right now isn't cheap. In other words, those growth companies are not cheap. And what's cheap right now, whether it's value or small cap or international, it's not good. It's not participating. You don't have the earnings growth. So you have to be very narrow in your thinking.
Did you notice how he said a Japanese bank went bankrupt and had to sell over $60 billion worth of U.S. treasuries? That was very important. I think this all has to do with Japan, and there is going to be a potential government intervention to stop the slide in the yen, which, if you guys are unfamiliar, the Japanese government and institutions are the largest owners of U.S. treasuries. Now, why is this important? Well, there's actually talk about Japan potentially going bankrupt. This article was actually written on May 7th of 2024, and it says if Japan goes bankrupt, the world will tremble. That is because Japan has a colossal debt load of 274% of GDP and a currency that is currently in free fall. And why is this all important? Well, based on what bonds did today, if this continues for a couple more days, you could get the Fed that intervenes and is forced to start cutting rates. Like, not the Japanese Fed. Fed Jerome Powell could have to intervene and start cutting rates because you could add just too much restrictiveness on this economy based on what's going on in Japan. This could actually be a financial crisis. Now, whether or not the Fed cutting rates because of what's going on in Japan and what's going on in our bond market, whether or not that would be good news for stocks, we'll talk about that in just a moment. But first, you need to hear this.
I think there is a particular line. If there was a line in the sand, you probably would have thought that it came, when we crossed 160, which is where we had the intervention. Obviously, previously back in late April and early May, our sense was that probably, MOF was probably minded to intervention, but they were looking for an opportunity, to kind of push on an open door. So perhaps looking for those inflation numbers on Friday to have generated maybe a bigger rally in US bond markets and a weaker US dollar, and they might have been disposed to lean into that as early as today, but clearly that hasn't happened. So I think the opportunity for successful intervention is pretty limited at the moment, and we do notice that there's been a break in the relationship between the US and Japanese bond yields and dollar yen. That relationship would tell you we should be down in the 140s. So there are clearly other things going on. We hear reports of strong Japanese household purchases of US equities, for example, under the tax-efficient savings plans that they have. That may be driving a little bit of a wedge there. So we do think the Bank of Japan is going to raise rates at the end of the month. We do think they will firm up their plans for reduced JGB buying. But in isolation, I'm not sure that is going to be a sufficient condition to bring about a meaningful reversal in the dollar-yen trend.
Hold on, Ray. They're going to firm up plans to taper JGB buying. So they're actually not going to pull the trigger because, as I understand it, I think the first available opportunity for them to actually do taper is probably coming up on, is it the 28th of July? Because we've been hearing reports that, things are so bad with the yen right now, they could be forced to do both. That is actually raise rates as well as trim bond buying.
No, that is our expectation, but what they said obviously out of the June meeting is that we aren't going to formally decide on the form and the magnitude of scaled back JGB buying until we meet in July. So if we see any reductions, I would imagine they'll still be within the current thresholds that the Bank of Japan has set for itself. But any formal reduction, I think only occurred August, having been announced out of the July meeting.
So basically what he was saying there is that the Japanese central bank may not be able to get the yen under control. And if they're not able to get the yen under control, then there is the real possibility of more bankrupts and more pain over in Japan, because Japan is a very import-based economy. About 60% of their food and about 90% of their energy is imported into the country. So as the Japanese yen continues to get worse, the financial situation in Japan continues to get worse at the same time. Now, I actually think it's very interesting that you got this bond market blowout globally today, one day before a new speech from Fed Jerome Powell. Now, let's be honest with ourselves. Powell does not want a calamity in the bond market. That's the last thing he wants. So he's going to try his best tomorrow to not be as hawkish as maybe some people think he could be. In other words, I think Powell's going to be pretty dovish tomorrow morning and try to drop those 10-year treasury yields, because it's just adding too much restriction on the economy, and especially in the banking sector and finance related sectors of our economy. When you have 10-year treasury yields like we've seen today gap up 12 basis points to open the trading day, that speed and velocity becomes a big problem, because banks cannot hedge if bond yields are gapping up. I mean, you gapped up today like a really bad CPI report, a really hawkish Fed FOMC, or something very bad. And especially if this financial situation could get worse for Japan in the next, coming weeks and months, the last thing Powell wants is to really, put his foot on the neck of the markets, specifically the bond market, and cause an even bigger problem. And I do think in a weird way that the Fed being forced to cut rates because of a problem in our bond market based on what Japan is doing and causing the problem in our bond market, that could actually be a positive for our markets. To see a little bit of a Fed Jerome Powell intervention in our markets, because as I have said many times here on this channel, the one thing you want to watch out for that gives you the 30, 40, 50% crash is if the Fed is cutting rates because they need to, because the economy is weakening. That's bad news. But if the Fed is forced to cut rates because of what Japan's effect is having on our bond market, maybe that would be positive news, because our economy presumably is still doing okay. It would basically just be a reason for the Fed to cut rates and have a strong economy at the same time. But I do think that is a little further down the line. I don't think that's going to be the first thing Powell jumps to, is cutting rates because of what Japan is doing to our bond market. But if you watch bonds get blown out for another couple of days, that could start to be a topic of conversation. And that may actually open up the door for that first rate cut coming July 31st. And coming tomorrow morning, if Powell thinks they should maybe cut rates by July 31st, Powell's going to try to open that door for the markets, which currently bond markets are assigning a 9.3% probability of the first cut coming July 31st. So if the Fed really wants to put that on the table more than where it is now at a, less than 10% odds, Fed Jerome Powell's time to do that is coming tomorrow. He will be speaking at 9:30 in the morning Eastern Standard Time, and that is right when our markets open. Now, back to this whole Japan situation here briefly, just to make matters a little bit worse. About 10 hours ago, Japan's GDP was downgraded much more than initially expected in Q1, and Japan's GDP shrank 2.9% year on year in the January through March quarter, more than the earlier estimate of 1.8%. So Japan's GDP for Q1 was negative 2.9%. Japan is most likely going to be in a recession here. It's probably already in a recession, but by the time the data comes out in about a month or so, they're already going to be in a recession. And again, when you have a GDP or debt to GDP ratio that is almost 300%, and a Japanese central bank that looks unwilling to take control of the slide in the Japanese yen, that could be a bigger problem for global bond markets, because that could mean more bond selling, especially if Japan does eventually go bankrupt, which there is concerns of that. And even as concerns grow that Japan could go bankrupt, markets price things in ahead of time. So as the odds start to rise of a Japanese bankruptcy, what happens? Bond yields start to rise. So I think Powell coming tomorrow is aware of this situation. I think he's probably met with the Japanese central bank, at least had a phone call with them, and does not want to make the situation any worse than it already is. And again, at the bare minimum, I do think Powell wants to cause a little bit more loosening in 10-year treasury yields from his speech tomorrow. In other words, he wants 10-year treasury yields to fall because they're getting too high. Again, we don't need this much restriction on the economy, and it's going to make the Fed's job a lot harder for their dual mandate, not just their price stability mandate, but their maximum employment mandate. As that 10-year treasury yield goes higher, potentially more economic weakness, more weakness in the labor market could come as an aftermath to that. And yes, I think that's the last thing Powell wants at this point. So I'm actually pretty bullish on tomorrow. I do think tomorrow could be a really good day in the markets. Now, also worth considering is, again, the first 2 weeks in July tend to be seasonally the best 2-week period of any time of any year over the last 100 years. But then again, I don't know exactly what Jerome Powell is going to say tomorrow, and there's a possibility he does not mention this whole Japan bond market situation at all, and well, nothing would happen. That's always a possibility as well. Let me know what you think about this information down below in the comment section. I felt like this was a pretty time critical video to get out for you guys, so as many people can go into tomorrow morning with the best understanding of this situation, because I was trying to figure out all day what was going on with bond markets, and it's pretty obvious. It has to do with Japan. I do think this does have implications for a Fed Jerome Powell that could be a little bit more on the dovish side, following what we've seen today in bonds. Let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. And if you made it to the end of this video, you might as well stick around a while and learn a thing or two. That's what we like to do here on this channel. Most importantly, guys, enjoy the rest of your day and night. I will see you in the next one.